Hey, welcome everybody to the North San Diego County Realtors uh, Tax Reform and Tax Planning Opportunities Workshop. Um, we see a bunch of attendees. If you guys have any questions as we go through this, feel free to raise your hand or comment in the Zoom, and we'll try to answer those questions. And we'll be getting started here in the next minute or so. All right, everybody, let's go ahead and get started. My name is Jesse Lipscomb. I'm an enrolled agent and investment advisor. We specialize in tax planning for real estate agents and real estate investors. We're going to talk about the 2025 tax reform today. And then we're also going to bring in some tax planning opportunities that can help both real estate agents and real estate investors. Um, Usually I just run through slides, and I use overviews as just I don't know, eye candy, if you will. But I want you to take a look at this slide and understand the really big deals of 2025 tax reform are just the fact that the 2018 Tax Cuts and Job Act provisions are now permanent. Okay. We were all about to pay a whole bunch more taxes January 1st when the old brackets were set to come back. Um, the good news is it's status quo, right? We're going to enjoy these lower tax brackets. They're permanent, and permanent means until uh, the folks in DC vote to change it. But I'll take that over the expiration of the tax brackets. The other thing is we brought back 100% bonus depreciation. That's huge for business owners and real estate investors. And now the state and local tax deduction limitation is $40,000 for most people. We'll go into the details in that. We'll also talk about tax planning opportunities, why this change to the $40,000 SALT now makes it a little bit more affordable for renters to become homeowners. So again, um, lots of little changes, but the big deals were the permanency. Okay, the brackets are going to stay the same. The standard deduction is now permanent. It's much higher than it used to be. Uh, you got a higher child tax credits. You still get to deduct 20% of your business profits if through the qualified business income deduction if you qualify. Some changes to 529 plans. And then, like I said, the big deal of bonus depreciation coming back and the state and local tax limitations are raised. So what does that mean really? If your adjusted gross income, whether you're single or married filing jointly, if it's $500,000 or less, you can write off up to $40,000 in property taxes, state income taxes, um, right there on your itemized deductions. If you make $600,000, then it'll go back to $10,000. And for married separately, it's all cut in half. Generally speaking, married separately has worse tax benefits than not. Um, Talking about the child tax credit, it's been $2,000 the last couple of years. Now it's going to be $2,200 per child, and that phases out at 200,000 single and 400,000 married joint. This is kind of interesting. 529 plans. If you've got money in those accounts for your kids, you can take out up to $20,000 a year now for K through 12 expenses. Additionally, there's some expanded eligibility, so now it's not just tuition, it can also be therapy. Now, the definition of therapy is interesting here because it could be emotional therapy, but it also could be athletic therapy, physical therapy, chiropractic care potentially. It depends on how you spend it. But if you've got a high school athlete doing some good things, you may be able to use your 529 plan um, to assist with that. Additionally, it's been expanded instead of just college, now potentially trades. So that'd be pretty awesome. If the school is eligible for student aid programs, 529 can be used for that. Most of our energy tax credits are are expiring. In fact, all of them. Um, the clean vehicle credits, even though they're through the end of the year, um, they're uh, essentially gone now because you had to have acquired the vehicle before the end of September. Okay, if you're going to go solar, you got to put that in by the end of the year. Um, and these are the temporary tax changes. I talked earlier about the power of all of the permanency, but there's a laundry list of littles that are just going to be for the next couple of years. They're interesting. I'm not going to spend a lot of time on them, but like I said, they're kind of interesting. First one is the deduction for seniors, single up to 75,000 a year, 150 married. It's an additional $6,000 per taxpayer, 12,000 married joint. That if you're 65 by the end of the year, it's just an additional senior deduction. What is that? The intention of it is to offset the taxes on Social Security. Okay. There's a new car loan interest deduction. Um, Full disclosure, most everybody on the call, this is worthless for you. And the reason I can say that is that as a business owner, you should be writing your vehicle off on either your Schedule C or through your S corporation. There are no limitations on what you can write off, or very few limitations what you can write off when you use something for business. This is a personal use vehicle, and it's only the ability to write off the interest associated. Of course, you get 0% financing, there's no interest to write off. Okay. The limits of 10,000 and 20,000, when you do the math on it, it just doesn't make sense to me. I mean, think about it. If you bought a $50,000 car and it was for your spouse, it wasn't for your business, and you were paying 5% interest on it, I mean, that's $2,500. The likelihood that you're going to get anywhere near $10,000, it's not likely. But the no taxes on overtime is pretty interesting, um, as well as no taxes on tips. Okay, both are kind of interesting on that. There's a new direct charity deduction of $1,000, single, 2,000 married. You can get that even without having to itemize. But I will tell you this, the ability for you to itemize has changed, where now there's a 0.5% floor. What does that mean? So maybe we go through it backwards. 60% AGI limit. That means if you made $100,000, the most you can write off for charity would be $60,000. Okay. But the first 0.5%, so 1% of $100,000 would be 1,000. So 0.5% would be $500. So you contribute 60,000 to charity, and the first $500 doesn't count. Okay. So we're back to the new SALT limits. Just again, make less than 500,000 single or married joint. It's up to $40,000. And we'll go through some practical examples of that momentarily in our tax planning opportunities. So a couple things we have here. Okay, if you have a family with young children, there is now what's called a MEGA account. That is the Middle Class American Growth Account. Technically, it doesn't launch until next year, but it's going to be kind of similar to an IRA regarding tax deferral, except the requirement that you have earned income, i.e., W-2 earnings or net self-employed earnings, isn't there. Up to 5 grand per child, up till age 18, parents, relatives, charities, even employers up to $2,500 a year can put money into that, up to $50,000 total. and children between that were born between 24 and 28 will also receive an additional $1,000 from the government, kind of as a as seed money, if you will. Um, Not a lot of details are out there right now because they're set to launch next year, but it's still pretty interesting if you've got a young child. Now, I'll tell you this much. One of the tax strategies out there is, oh, hire your kids. I've never been big on that because the reality is, are your kids really working in your business, right? But if you wanted to give your children seed money for the future, uh, through these middle class American growth accounts, you can do that up to $5 grand a year. So let's transition now to homeowners. These are your clients buying a house. Um, a couple of different things we're going to try to illustrate here. Number one, we're going to illustrate the difference between renting and owning, as well as how the new SALT limit change applies, as well as how the acquisition indebtedness limit remains. So let's look at that one first. It used to be that if you bought a new home, you could write off the interest up to $1 million on the loan. Okay, so if you bought a $1 million house, 100% financing, you could write off all the interest on that $1 million loan. Since 2018, it's been $750,000. And that means, like, for example, you sell a house, you take $750,000 and you uh, put it as a down payment on a $1.5 million house. You're financing 750. All that interest would be tax deductible. Okay. So you buy a $2 million house and you put $500,000 down and you've got a $1.5 million loan. Only 50% of that interest will be tax deductible because you're capped at 750. Okay. So in this scenario, married or single, they're going to make $200,000 total. Buying a home zero down VA, $750,000. Property taxes are about $9,300 a year, and with 100% VA loan, no funding fee, you're at $4,700 a month, 48 grand a year in interest. Okay. So given those assumptions, let's take a look at somebody that's renting out a house, 200 grand a year of income, W-2, like I said, standard deduction, taxable incomes, 185. And so they're going to pay $37,000 to the IRS and 14,000 to California. It's $52,000 in real taxes. Okay. However, same scenario, that $750,000 property, right off the state and local taxes, right? The property taxes, local taxes, California income taxes, state taxes, minus your mortgage. Okay. You're going to notice that the $9,300 in property taxes and the $6,800 of California income tax, that combined is over 10 grand. But since they make less than 500,000, they're protected by that new $40,000 limit. Property taxes, California income taxes, mortgage interest, add it all together, write that off against the income. Now your taxable income is 135, which means there's 25,000 in IRS taxes and 6,000 in California taxes. So literally $19,000 a year. That's more than $1,500 a month of tax benefits in order to buy the property. Okay. Same exact scenario married. What you're going to find is the standard deduction is higher and the tax rates are offset lower. So the married person making 200,000 is going to have $38,000 in total taxes. Everything else being equal, same 135 taxable income, uh, lower income taxes, state and federal. So you're at 26,000. Compare that. The married homeowner will save $12,000 a year, about $1,000 a month. And again, why is that? Everything else being equal, it's the same amount of mortgage interest, same uh, property taxes, et cetera, et cetera. Um, it's just simply that the tax brackets are lower for married than single up to 200 grand. So comparing that again, single homeowner can save $19,700 a year by buying a house. Married 12,000 a year. Still pretty good. So, the McRib is back, man. We got 100% bonus depreciation. That is effective January 20th of this year, not January 1st. Okay. Um, it's permanent. And we can go to our three commonly depreciated assets of vehicles, equipment, and real estate. And just so we're on the same page, depreciation is just a wear and tear allowance. Okay. Bonus depreciation, section 168K, is an ability for you to take the depreciation in the first year as opposed to over time. Okay. Again, like I said, three most commonly depreciated assets: vehicles, equipment, and real estate. Real estate has an asterisk because you can't depreciate land. But vehicles, if you're as a real estate agent acquiring a 6,000 pound truck or SUV, awesome. We can write it all off in the first year. If you're buying a passenger vehicle, a car, it has to be under $55,000, because if you buy an $80,000 luxury sedan, it's over $55,000. It's under 6,000 pounds. You're not going to be able to accelerate that depreciation. Okay. Equipment. Equipment has a standard 5-year depreciation schedule. An example here is if you have a ranch, or if you have a rental property and you wanted to acquire a $100,000 skid steer, you can either A, take the $100,000 in first year depreciation via bonus depreciation, or you can opt out of it and take $20,000 a year for 5 years. Depending on the tax situation, both are good. Back to real estate, all real estate is a combination of land and improvements. The standard is 27.5 year depreciation. So $1.5 million property, the county records say that the land is $500,000, so the improvements are $1 million. You divide that million divided by 27.5 years, and so you get $36,000 a year depreciation. If you were charging $3,000 a month of rent, that rent is tax-free to you because the depreciation wipes it out. Okay. You might have heard of cost segregation studies. All that is an engineering report to break down the improvements between structural and non-structural components. Non-structural components can be depreciated over 5, 7, 10, or 15 years instead of 27.5, and they're eligible for section 168K accelerated depreciation. So same property as before, $500,000 in land, $1.5 million property. The cost segregation study reveals that the structural aspects of the house were $700,000. So that's still 27.5 years, 25,000 a year of annual depreciation. But the non-structural components were 300,000. So accelerating the depreciation on the non-structural components gives us $300,000 in the first year, or actually 325,000 once we add in the long-term structural depreciation. So how does this benefit you as a real estate agent? You're having a great year, you're making $325,000 of profits, and you go out and you buy a $1.5 million rental property, do the cost seg, you're going to completely tax balance your federal income taxes. Okay. The only negative with this for folks in California is the fact that California doesn't conform. In doing a cost segregation study, California will give you the depreciation of 5, 7, 10, or 15 years, but they won't let you take it all up in the first year. So you'll still save California taxes by doing a cost seg. It just won't be as impactful as the federal study. So, little recap here. The big deal of 2025 tax reform is that the changes made from 2018, specifically the tax brackets, standard deductions, are now permanent. Solar tax credits and clean energy vehicle credits, those are expiring. And there's some smaller tax changes that expire over the next 3 years. But the real big deal is having 100% bonus depreciation and permanency to the tax brackets. The $40,000 state and local tax limitation is also a nice thing. Next year, we'll find out more about the mega accounts to putting money away for your children. And right away, we can benefit our rental clients, become homeowners by being able to write off more of the property taxes and state income taxes as they buy a home. And we can utilize bonus depreciation and cost segregation studies to benefit massively tax-wise on our rentals and actually in our businesses.
You just got a question.
Oh,
Can you
can you
explain a
explain?
gift tax in real estate?
Sure. And Stacy, yeah, absolutely. I will forward uh these slides to Shirley and she can distribute them. I'll put them in a PDF. So gift tax in real estate. So let's talk about that a little bit. Um, let's say that you're buying a house and your parents are going to give you a gift of $100,000 as a down payment. Okay. So the first question is it taxable? And the easy answer to that is generally it's not. Generally, it is not taxable. Okay. Gifts to the recipient are tax-free, and the person making the gift is generally not taxable to them. The thing that should happen in a situation like this would be a gift tax return. So I'll Google this with you right now, right? So if we looked at a gift tax return, you're going to notice that the IRS 709, it's a gift and generation skipping transfer tax return. And basically, right now we've got it was like a $14 million estate tax exemption, right? 2025 estate tax exemption is 13.99 million per person, almost 28 million for a family. So the only concern that people should have is if they make a gift to their children in excess of $19,000, they're actually supposed to file this form. Um, it's interesting uh, because from a real practical standpoint, um, regular people with regular estates far under 14 million, um, I haven't seen it being too common that they'll actually do this, but they're supposed to. For people that have a lot of wealth, they definitely have to do it because um, their estates will be more heavily scrutinized. Okay, there is one thing that you have to be cognizant of, and that is uh, gifts from foreign estates. So when you do that, you actually have to report something else. So the IRS says right here, large gifts or bequests from foreign peoples. Okay, again, it's not taxable to you, but it's reportable, and that's where IRS Form 3520 comes in. So, um, Marina, does that answer the question okay? Cool. All right, perfect. All right, anybody else with any other general questions? Oh, okay. So what about when you put somebody in title? This is a little different, okay? So now all of you should be familiar with the PCOR, okay? San Diego County PCOR. And the reason I say you should be familiar with this is that every single time you sell a home, this is created in escrow. Okay. And the purpose of this form is to see whether or not the transfer of the property is going to be reassessed property taxes or if it was eligible for some kind of an exclusion. So, for example, um, a transfer between spouses. All right, you get married and you put your spouse on the title. That's a non reassessed transaction. Okay. Similar, the opposite's also true. You own the property with your spouse, you remove the spouse for either refinancing purposes or maybe a part of a divorce settlement. Um, a transfer between spouses is not reassessed. I see a lot of times, Jay, where mom and dad co-sign for their adult child, and then the kid's going to sell the house, and right before escrow, right before it's sold, they remove the co-signer because mom and dad were really just the co-signers. Okay, so the question is, what if you put somebody on the title of your home? Is it a gift? Again, we can look at this a couple of different ways. I mean, technically, yeah, it'd be a gift, right? You're gifting them equity in your home. The question is, when that happens, to what extent is it going to be reportable? Well, even in the PCOR, in this scenario, let's say you, um, husband and wife, or just a single person owns the property, and they add somebody else. They're going to go from 100% ownership to 50% ownership. And technically, that gift or transfer now changes the ownership of the property, and that may be reassessed for property taxes. Now, you can notice here the PCR talks about, what type of transfer is it? Is it a gift? Is it a purchase or whatever? Um, but you got to be very careful about adding people to title because it may ultimately get the property taxes reassessed. I think this Prop 19 aspect was the one that was most historically uh, done. So if we do that real quick, we go to Prop 19 BOE, we can see that the comparison charts here are pretty nice. If it's the owner's principal residence and the person that they're transferring it to also lives there, then you could check uh, box E as well as here the gift, and that would keep it from being reassessed. Um, question is the PCOR also for the sale of mobile homes? I'm going to say I think so. I've I'm pretty sure. Uh, does San Diego County require a PCOR for mobile home? Oh, well, there it is. Okay, so PCR is only required if the mobile home is subject to local property tax. So in the situation you're asking where there's no land, um, again, you'll have to see if that particular property is subject to property taxes or not. But I would assume that no land means no property taxes. Um, but I will tell you this, and this is um, a strategy that people use that is better than nothing, but I don't think it's great. A lot of times, what parents will do is that they'll add their adult children. Again, there's a transfer between parents and children, right? Um, it- they'll use that uh, in lieu of a living trust. Um, and from a tax standpoint, joint tenancy is much worse than inheriting something. Okay. And the math on it, I mean, the math is really easy. I'll do this. This is a modified example of a real client I had from years ago where mom and dad bought the property for 15 million or 50 million, $15,000 in the 70s. And they just they just gifted it to their adult children. Well, what happens in that situation? Let's say this is actually exactly what it looked like. Mom and dad owned the property for $15,000. They gifted the property in its entirety as joint tenancy to their two adult children. So that means that the cost basis for gains is $15,000. And when mom and dad passed away, the house was worth $1 million, but the children didn't get a step up in basis at $1 million because they already owned the property. The title was already in their names. And so, I mean, practically speaking, they had $1 million gain here on a second home. We were able to use a strategy based on Section 453 to defer the taxes over time. But without that strategy, they would have had a substantial tax bill. All things being equal, had the mom and dad, the original owners, put this property into a trust and had their children as the beneficiaries of the trust, they would have received the $1 million property with $1 million basis and could have sold it without any taxes. Okay. So just a word of caution. If, I mean, look, if you're going to add an adult child to a property, either as a cosigner or as a gift, not the end of the world. It won't be federally taxable, although they should file a 709 gift tax return. And it may or may not be reassessed property taxes. It just depends on which one of these exemptions they qualify for. Okay. If you guys need any help, roadmaptax.com. You can call or email us through there. We're willing to help. And hey, man, thanks for attending.